If you're over 65, a series of recent rule changes could either protect your savings or quietly drain your bank account this year, and most people have missed the headlines completely. We're on the verge of the highest age for collecting full Social Security we've ever seen, officially hitting 67 in late 2026 for anyone born in 1960 or after. This caps off a slow climb that began over 4 decades ago. Social Security payments saw a cost of living bump this January, pushing the average monthly checkup. But here's a twist many aren't aware of. If you're still working and collecting benefits before hitting that full retirement age, your earnings face a strict ceiling. For 2026, that limit is $24,480. Go beyond it, and they'll hold back $1 from your benefits for every $2 you earn over that line. There's also a fresh tax break for those 65 and up, a $6,000 deduction that can slash what you send to the IRS, but it vanishes after 2028, and countless people don't know it's there. Meanwhile, the standard Medicare Part B premium has risen, now taking a bigger bite from that COLA increase you just got. Plus, another state has just wiped out its tax on Social Security income entirely. In the next few minutes, we're covering 10 crucial updates that will touch your retirement cash, your medical bills, and your overall financial safety this year. Some are wins, others could be costly surprises if you're not ready. Let's begin with an adjustment hitting almost every viewer, the Medicare Part B premium hike that started affecting accounts this very month. If your January Social Security deposit didn't seem to grow as much as you anticipated, this is the reason. The standard Part B monthly premium climbed from its 2025 level up to $202.90 for this year. Now, that might not initially sound like a huge jump, but it means an extra $17.90 is being subtracted from your benefit before the money ever reaches you. Over a full year, that's more than $214 staying in the government's pocket instead of yours. And here's the part that really grinds people's gears. This increase lands at the exact moment you're receiving your annual cost of living raise. So while the COLA gives the average retiree about $56 more each month, Medicare instantly reclaims around $18 of that. The annual Part B deductible also increased, moving from $257 to $283, meaning you pay more upfront before your insurance starts sharing the load. And if your income is above a certain threshold, think over $103,000 for a single person or above $206,000 for a married couple, you'll pay even steeper premiums through special income-based adjustments. Some individuals are facing Part B premiums as high as $689.90 per month in 2026, a truly staggering figure when you let that sink in. Now, let's discuss that new tax deduction that could put serious money back in your account. This is a provision flying under the radar for a massive number of seniors. Beginning with the tax return you file in early 2026 for the 2025 year, there's an additional $6,000 deduction exclusively for those age 65 or older. This isn't a swap for the higher standard deduction seniors already get. It's an extra layer on top, making it even more valuable. Here's the breakdown. If you file taxes as a single person and reached age 65 by the last day of 2025, you can claim this $6,000 bonus. Married couples where both partners are 65 or older can claim a combined $12,000. But, and this is critical, this benefit shrinks as your income rises, disappearing entirely past certain limits. For singles, the phase-out starts at a modified adjusted gross income of $75,000 and is fully gone at $175,000. For married couples filing together, the phase-out begins at $150,000 and vanishes at $250,000. The crucial point is, this deduction is available whether you take the standard deduction or you itemize, which is unusual and makes it super useful for many. Sadly, it's not permanent. It's scheduled to sunset after the 2028 tax year, so you have a 4-year window to use it before it's gone. The earnings test for people collecting Social Security before full retirement age has also been updated for 2026. This rule trips up countless individuals who don't realize that working while receiving benefits can shrink their monthly payments. If you remain below your full retirement age for all of 2026, you can only make $24,480 before Social Security begins withholding from your checks. That's up from last year, but the penalty formula is unchanged. For each $2 you earn past that ceiling, they will withhold $1 from your benefits. Let's walk through a real scenario so you see the impact. Imagine you get $800 monthly from Social Security, totaling $9,600 annually. Now suppose you have a part-time job and earn $33,400 this year. That's $8,120 over the allowed limit. Social Security will hold back $4,460 of your benefits, so instead of the full $9,600, you'd receive just $5,140. Now here's a bit of comforting news many find reassuring. This withheld money isn't lost for good. Once you hit full retirement age, Social Security recalculates your benefit to account for those months when payments were reduced. But in the immediate term, it can cause a real cash flow problem if you're caught unprepared. There's a separate, gentler rule for those who will hit their full retirement age sometime during 2026. For them, the earnings limit is a higher $65,160, and the penalty is $1 withheld for every $3 earned over that mark. Once you actually attain your full retirement age, this earnings test vanishes entirely, and you can earn any amount without your benefits being touched. Speaking of full retirement age, 2026 represents a major endpoint many haven't noticed arriving. For anyone born in 1960 or later, the full retirement age has now peaked at 67 years old. This is the finish line of a gradual rise that began in 1983 when lawmakers voted to incrementally push the age up from 65. Practically, this means if your birth year is 1960 or after, you must wait until 67 to get your full, unreduced Social Security benefit. You can still start as early as 62, but your monthly check will be permanently cut by roughly 30%. Conversely, if you can delay claiming past your full retirement age, you boost your benefit by 0.23% each month you wait, totaling 8% yearly until you hit age 70. After 70, there's no financial reward for further delay. So that's the point where you should absolutely start collecting if you haven't already. The earnings required to get Social Security work credits have also risen for 2026. This matters for people still building eligibility or for younger viewers helping their parents. You need 40 credits total to qualify for retirement benefits, and you can earn up to 4 per year. This year, you must earn $1,190 to get 1 credit, an $80 increase from 2025. To get all 4 credits for the year, you need at least $7,560 in earnings. It seems minor, but it's part of the annual inflation adjustment Social Security makes to match wage trends in the broader economy. The maximum earnings subject to Social Security tax has also jumped significantly, reaching $185,500 for 2026. That's a rise of $8,400 from last year's cap. For most retired viewers, this doesn't hit you directly, but it's useful to grasp because it affects what younger workers pay into the system, funding your benefits. The tax rate itself is unchanged, 6.2% for employees, with employers matching another 6.2% or 12.4% total for the self-employed. But with the higher wage cap, top earners will pay more in this year. Someone earning at or above the new cap will pay a maximum of $11,439 in Social Security taxes for 2026. Interestingly, Medicare taxes have no upper limit. Every dollar earned gets hit with the 1.45% Medicare tax, and high earners pay an extra 0.9% on income beyond specific thresholds. Now here's a shift that puts real cash back into people's hands, and it's happening at the state level in West Virginia. Starting this year, West Virginia has fully erased its state income tax on Social Security benefits for every resident, no matter their income. This is the last step of a 3-year phase-out that began with a 35% reduction in 2024, moved to a 65% cut in 2025, and is now 100% gone. This impacts about 480,000 West Virginians who get Social Security, with savings ranging from several hundred to thousands of dollars annually based on what they used to owe. State politicians passed this with support from both parties after seeing too many retirees relocate to states that don't tax these benefits. West Virginia now stands with 41 other states that impose no state income tax on Social Security, leaving just 8 states that still do. If you live in Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, watch what happened in West Virginia, because there's mounting push for these remaining states to do the same. Let's switch focus to prescription medicine costs, because 2026 brings some genuinely good news that could save thousands. For the first time, Medicare has successfully bargained for lower prices on 10 expensive drugs. These new prices took effect January 1st. The list includes medicines like Eliquis for blood clots, Jardiance for diabetes, Entresto for heart failure, Stelara for immune diseases, and others that millions on Medicare depend on daily. Research indicates people on these drugs might see their personal costs fall by roughly half compared to 2025. For some medications, we're talking monthly savings in the hundreds. The drug with the largest dollar amount drop is Stelara, where certain patients could save over $3,000 yearly on their out-of-pocket expenses. 7 of these 10 drugs now cost Medicare users less than $100 per month, a huge shift from just a year ago. This stems from legislation passed a few years back that finally allowed Medicare to negotiate drug prices. The list will grow, with 15 more drugs joining in 2027 and even more in following years. There's also an update to the out-of-pocket maximum for Medicare Part D prescription coverage. For 2026, the cap is $2,100, a small increase from the $2,000 cap that began in 2025. Once your spending on covered medications hits $2,100, you pay zero for the rest of the year. This cap includes your deductible, co-pays, and co-insurance. Everything counts toward it. The Part D deductible itself has also risen to $615 for this year, up from $590. Now here's a handy feature many overlook. There's an option called the Medicare Prescription Payment Plan that lets you pay your drug costs in monthly pieces instead of one lump sum at the pharmacy. Starting now, if you were in this plan during 2025, it will automatically renew for you unless you tell them to stop. This can be a financial lifesaver for those on pricey medications early in the year who would otherwise need a big chunk of cash up front. Insulin users continue to get protection in 2026, with co-pays for covered insulin products limited to $35 for a 1-month supply under Medicare Part D. The best part? The deductible doesn't apply here, so you get this price starting day one. For diabetics who use insulin regularly, this means massive savings, as some forms once cost hundreds monthly before this cap existed. One surprise catching people off guard is that some Medicare Advantage and Part D plans have either exited certain regions or changed their offerings significantly. The total count of Medicare Advantage plans dipped slightly this year, and in some parts of the country, people have fewer choices than before. Some who'd been with a plan for years discovered during the fall enrollment period that their plan was leaving their area, forcing a last-minute switch. This can lead to folks paying higher premiums or getting less coverage than they're accustomed to. It's a clear reminder why reviewing your options annually during Medicare open enrollment, October 15th to December 7th, is essential, rather than just letting your plan auto-renew. The maximum out-of-pocket limit for Medicare Advantage plans actually decreased a bit for 2026, falling to $9,250 from $9,350 last year. This is the absolute most you could pay for in-network services under Parts A and B with such a plan. Most plans have limits well below this maximum, but it's good to know the ceiling exists. Looking at all these updates together, the overall picture comes into focus. Some developments are positive: the new senior tax deduction, West Virginia axing its Social Security tax, and negotiated drug prices finally lowering costs for critical medications. But other aspects are growing pricier, especially Medicare Part B premiums rising faster than the Social Security COLA, which squeezes the actual buying power of your benefits. The secret to managing all this successfully is staying updated on what's new, scrutinizing your options every open enrollment season, and ensuring you claim every tax advantage and benefit you qualify for. These laws and rules are complex, no doubt, but understanding them can literally keep thousands of dollars in your pocket over a single year. That's money you could spend on what truly brings you joy in retirement instead of seeing it go to insurers or the tax office. If this breakdown helped clarify things for you, please show some love by hitting the like button. It genuinely supports the channel, and be sure to subscribe to my channel for clear, timely updates that help you secure your financial future. Thanks for watching.